Look, something just happened in the gold market that most people completely missed. And I'm not talking about some minor price fluctuation or technical pattern. I'm talking about a fundamental shift in how the world's largest financial institutions are positioning themselves right now. And if you're holding cash, or if you've been sitting on the sidelines waiting for the right time to protect your wealth, you need to understand what just happened in the last 72 hours. Because here's the thing. Gold didn't just react to the news. Gold anticipated it. And that tells you everything you need to know about where we are in this cycle. Let me show you exactly what I'm seeing, because the implications are massive. And I mean that literally. We're talking about a potential restructuring of the global monetary system, and gold is sending us signals that most investors are completely ignoring. So December 2024 just closed, and if you look at the price action, you might think gold had a rough month. It pulled back from its highs. Some analysts are calling it a correction. Some are saying the rally is over. But here's what they're missing. While gold was pulling back in price, something else was happening behind the scenes. Something that contradicts everything you're seeing on the surface. Central banks just reported their gold purchases for the fourth quarter. And the numbers are staggering. We're not talking about a few tons here and there. We're talking about systematic, aggressive accumulation at levels we haven't seen since the 1970s. The People's Bank of China added another 160 tons in the final quarter alone. That's on top of the 225 tons they added earlier in the year. But here's the kicker. These are just the official numbers. The actual accumulation is likely much higher. Why? Because central banks have learned to be strategic about their disclosures. They don't want to move the market against themselves. So they buy through intermediaries. They use off-market transactions. They accumulate slowly and quietly. And then, months later, they report what they've already done. Think about that for a second. While retail investors were watching the price pull back and thinking the rally was over, the world's most sophisticated financial institutions were backing up the truck. They were buying with both hands. And they weren't buying because they thought gold might go up 5 or 10%. They were buying because they know something fundamental has changed in the global financial system. Let me tell you a story that illustrates exactly what's happening right now. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. And at that moment, the entire global monetary system changed. We went from a gold-backed system to a pure fiat system. And you know what happened to gold over the next decade? It went from $35 an ounce to $850 an ounce. That's a 2,300% increase. But here's what most people don't understand about that period. Gold didn't just go straight up. It had massive pullbacks. In 1974, gold dropped 40% from its highs. People thought the rally was over. They thought gold was done. And then it went on to multiply several more times over the next 6 years. Why am I telling you this? Because we're in a similar moment right now. The global monetary system is going through a fundamental transformation, and gold is reacting to that transformation. But it's not reacting in a straight line. It's reacting in waves. And right now, we're in one of those waves that's confusing everyone who doesn't understand the bigger picture. So let's talk about what actually triggered this latest reaction, because it's not just one thing. It's a convergence of multiple factors that are all pointing in the same direction. First, the Federal Reserve just signaled that they're done with rate hikes. Now, they're not saying they're going to cut rates tomorrow, but the market is reading between the lines. And what the market is seeing is that the Fed has painted itself into a corner. They raised rates to fight inflation, but in doing so, they've created a situation where the government's interest payments on the national debt are now over $1 trillion per year. That's more than we spend on defense. That's more than we spend on Medicare. Think about the implications of that. Every time the government issues new debt, they're paying higher interest rates, and they have to issue new debt constantly because we're running trillion-dollar deficits. So the debt is growing, the interest payments are growing, and at some point, something has to give. Now, the Fed can do one of two things. They can keep rates high and watch the government's interest payments spiral out of control, or they can cut rates and watch inflation come roaring back. Either way, the dollar loses. And that's exactly what gold is telling us right now. But it gets deeper than that. Because while the Fed is dealing with this impossible situation, other central banks around the world are making a different calculation. They're looking at the dollar's dominance in the global financial system, and they're asking themselves a very simple question. Do we want to be holding trillions of dollars in reserves when the Fed is trapped between inflation and insolvency? And the answer, increasingly, is no. That's why you're seeing this massive shift into gold. It's not just China, it's not just Russia, it's Poland, it's Singapore, it's India, it's Turkey. Countries that have historically held most of their reserves in dollars are now diversifying into gold at record pace. Let me give you some specific numbers because this is where it gets really interesting. In 2023, central banks bought 1,037 tons of gold. That was a record, but in 2024 they're on pace to exceed that. The World Gold Council estimates that central bank purchases will hit 100 tons or more by year-end. And remember, these are just the reported purchases. Now, why does this matter? Because central banks don't buy gold for short-term trading profits. They buy gold as a strategic reserve asset. They buy gold because they're preparing for a scenario where the current monetary system doesn't work the way it used to. And when you see this kind of systematic accumulation, you have to ask yourself what they know that the average investor doesn't. Here's another piece of the puzzle that most people are missing. The BRICS nations just announced they're accelerating their plans for an alternative payment system. Now, this has been in the works for years. But what changed recently is the urgency. They're not talking about implementing this in 5 or 10 years. They're talking about implementing it in the next 12 to 18 months. And guess what's going to back this new payment system? It's not going to be backed by the dollar. It's going to be backed by a basket of commodities, with gold playing a central role. Now, I'm not saying this is going to replace the dollar overnight, but I am saying that for the first time in 80 years, there's a credible alternative being built. And the market is starting to price that in. You can see it in the gold to dollar ratio. You can see it in the way gold is holding up even as real interest rates have risen. You can see it in the divergence between paper gold and physical gold. The premium for physical gold has been widening. That tells you that people who actually want to own gold, not just trade it, are willing to pay more to get their hands on the real thing. Let me tell you about something that happened in the COMEX market recently that really opened my eyes to what's going on. In November, we saw one of the largest deliveries of physical gold in COMEX history. Over 400,000 ounces stood for delivery. Now, normally, most COMEX contracts are settled in cash. People trade the contracts, they don't actually take delivery of the metal. But increasingly, that's changing. Why? Because sophisticated players are realizing that paper gold and physical gold are not the same thing. Paper gold is a claim on gold. Physical gold is actual gold. And in a crisis, that difference matters enormously. So what you're seeing is a slow-motion run on the COMEX. Not a panic run, but a steady, persistent demand for physical delivery that's putting pressure on the system. And here's where it gets really interesting. The COMEX has about 25 million ounces of gold in its registered vaults. That sounds like a lot. But there are over 500 million ounces of open interest in gold futures. That means for every ounce of physical gold in the registered vaults, there are 20 ounces of paper claims. Now, as long as most people are happy to settle in cash, the system works fine. But if even a small percentage of contract holders start demanding physical delivery, the whole thing breaks down. And that's exactly what gold is reacting to right now. It's reacting to the growing realization that the paper gold market is built on a foundation that's much shakier than most people understand. Now, let me pause here for a second, because if you're sitting on $100,000 or more in retirement accounts, this is something you need to be thinking about seriously. I put together a free guide on how gold IRAs work. It's in the description below. It covers exactly how you can get physical gold into your retirement account without triggering tax penalties. It's worth checking out if you're concerned about protecting your retirement savings in this environment. All right, back to what's happening in the market. So we've talked about central banks. We've talked about the BRICS. We've talked about the COMEX. But there's another factor that's driving this reaction in gold that most people aren't paying attention to. And that's the commercial banks. See, commercial banks have been net short gold for years. They've been betting against gold as part of their hedging strategies. But in the last quarter, something changed. The commercial short position has been shrinking dramatically. The big banks are covering their shorts. They're reducing their exposure, and in some cases they're actually going long. Why would they do that? Because they have access to information that retail investors don't. They see the order flow. They see what their institutional clients are doing. They see the central bank purchases before they're reported. And what they're seeing is telling them that the risk-reward on being short gold has completely flipped. Think about it from their perspective. If you're a commercial bank and you're short gold, you're essentially betting that the current monetary system is stable. You're betting that central banks won't debase their currencies. You're betting that there won't be a crisis that drives people into safe haven assets. But if you look at the world right now, how confident can you really be in any of those assumptions? You've got geopolitical tensions at levels we haven't seen since the Cold War. You've got debt levels that are completely unsustainable. You've got inflation that's proving much stickier than anyone expected. You've got a banking system that's still fragile from the regional bank crisis earlier this year. And you've got a Fed that's trapped between impossible choices. In that environment, being short gold is not a hedge. It's a liability. And the smart money is recognizing that. Now, let's talk about what this means for price. Because ultimately, that's what everyone wants to know. Where is gold going from here? Here's what the technical picture is telling us. Gold is currently consolidating in a range between $2,600 and $2,800 per ounce. It's building a base, and historically, when gold builds a base like this after a major rally, it's preparing for the next leg up. The question is not if gold is going higher. The question is when and how high. If you look at the Fibonacci retracement levels from the recent rally, gold has pulled back to the 38.2% retracement. That's a healthy correction. That's exactly what you want to see in a bull market. It shakes out the weak hands, it resets the sentiment, and it sets up the next move higher. But here's what's different about this consolidation compared to previous ones. The volume profile is completely different. During previous corrections, you'd see volume spike as people rushed to sell. But this time, volume has been relatively light. That tells you that holders aren't panicking. They're not rushing for the exits. They're comfortable holding at these levels. And on the buy side, you're seeing consistent accumulation. Not panic buying. Not FOMO. Just steady, persistent buying from sophisticated players who understand the bigger picture. Now let me give you some price targets based on what I'm seeing. In the near term, I think gold is going to break out of this consolidation range and test $2,900 to $3,000. That's the next major resistance level. And if it breaks through that, which I think it will, then we're looking at $3,500 to $4,000 as the next target. But here's the thing. Those are just the technical targets. The fundamental targets are much higher. If we see a real crisis in the dollar, if we see the BRICS payment system gain traction, if we see a flight to safety from the bond market, gold could go much higher, much faster than anyone expects. Let me give you a framework for thinking about this. Gold's all-time high in 1980 was $850 per ounce. If you adjust that for inflation using the official CPI, that's about $3,200 in today's dollars. But if you use the real inflation rate, the one that actually reflects what's happened to the money supply and the cost of living, that 1980 high is closer to $5,000 or even $6,000 in today's dollars. So when people say gold is at all-time highs, they're technically correct in nominal terms. But in real terms, adjusted for the debasement of the currency, gold is still well below its previous peak. And that's before you factor in all the new dynamics we've been talking about. The central bank buying, the BRICS alternative, the COMEX stress, the commercial bank positioning. When you put all of that together, the case for significantly higher gold prices becomes very compelling. But let's talk about the risks, because I want to give you the full picture. What could derail this? What could cause gold to go down instead of up? The main risk is if the Fed somehow manages to engineer a soft landing, if they can bring inflation down without causing a recession, and if they can do it while keeping the dollar strong, that would be negative for gold in the short term. But here's the problem with that scenario. It's never happened before. The Fed has never successfully engineered a soft landing after raising rates this aggressively. The historical precedent is that they either cause a recession or they reignite inflation. Either way, gold wins. The other risk is if we see a major deflationary event. If there's a credit crisis that causes a collapse in asset prices and a scramble for dollars, gold could pull back in the short term. We saw this in 2008. Gold dropped from $1,000 to $700 in a matter of months as everyone rushed to raise cash. But then what happened? Gold went from $700 to $1,900 over the next 3 years as the Fed responded with massive monetary stimulus. So even in the worst-case scenario, gold's pullbacks tend to be temporary, and they tend to set up even bigger rallies on the other side. Now let me tell you about something that happened in 2011 that I think is really relevant to where we are today. Gold hit $1,900 per ounce in September 2011. Everyone thought it was going to $2,500 or $3,000, but instead it topped out and went into a bear market that lasted for 4 years. It bottomed at $1,050 in December 2015. Why did that happen? Because the Fed convinced the market that they had everything under control. They convinced people that the financial crisis was over, that the economy was recovering, and that they could normalize monetary policy. And for a while, people believed them. So gold went down. But here's what's different now. Back in 2011, the national debt was $15 trillion. Today, it's $36 trillion. Back in 2011, the Fed's balance sheet was $2.8 trillion. Today, even after their quantitative tightening, it's still over $7 trillion. Back in 2011, we weren't dealing with a geopolitical challenge to the dollar's reserve status. Today, we are. The point is, the problems that gold is reacting to now are much bigger and much more structural than they were in 2011. And that's why I don't think we're going to see a repeat of that bear market. I think we're in the early stages of a secular bull market in gold that's going to last for years, not months. Let me give you another historical parallel that I think is even more relevant. In the 1970s, gold went through 3 distinct phases. Phase 1 was from 1971 to 1974, when gold went from $35 to $200. Then it corrected 40% and everyone thought it was over. Phase 2 was from 1976 to 1980, when gold went from $100 to $850. And Phase 3 was the bear market from 1980 to 2001, when gold went from $850 back down to $250. Now, where are we in that cycle today? I think we're somewhere between Phase 1 and Phase 2. We've had the initial rally, we've had the correction that shook out the weak hands, and now we're setting up for the big move. The move that takes gold from $2,000 to $5,000 or higher. And here's why I'm confident about that. The fundamental drivers are all in place. The monetary debasement is accelerating. The geopolitical tensions are intensifying. The central banks are accumulating. The commercial banks are covering their shorts. The physical market is tightening. And the retail investor hasn't even shown up yet. That last point is crucial. If you look at gold ETF flows, retail investors have actually been net sellers this year. They've been taking profits. They've been rotating into other assets. The rally we've seen so far has been driven almost entirely by institutional and central bank buying. When retail finally wakes up and starts piling in, that's when you'll see the real fireworks. And that's what gold is reacting to right now. It's not reacting to any single news event. It's reacting to the accumulation of evidence that we're at a major turning point in the global financial system. It's reacting to the realization that the monetary experiment we've been running for the last 50 years is reaching its limits. And it's reacting to the growing understanding that gold's role as a monetary asset is being reasserted after decades of being dismissed. Let me tell you one more story that really drives this home. In 2008, during the financial crisis, there was a moment when the entire global financial system almost collapsed. The credit markets froze. Banks stopped lending to each other. And for a brief period, the only asset that anyone wanted was physical gold. Not gold ETFs, not gold futures, physical gold bars and coins. And you know what happened? You couldn't get them. The premiums on physical gold spiked to 20, 30, even 40% above the spot price. Dealers were sold out. Mints couldn't keep up with demand. And if you wanted to buy gold, you had to wait weeks or even months for delivery. Now, we're not in a crisis like that right now, but the warning signs are there. The premiums on physical gold are starting to widen again. The delivery times are starting to stretch. And the smart money is positioning itself before the crowd figures out what's happening. That's what this market shift is all about. It's about the early movers getting positioned before the obvious becomes obvious to everyone else. And gold's reaction to the news, whatever specific news triggered the latest move, is telling you that the early movers are moving right now. So what should you do with this information? Well, that depends on your situation. If you don't own any gold, this is probably a good time to start building a position, not all at once, but systematically, over time, as part of a diversified portfolio. If you already own gold, this is probably a good time to hold and potentially add on any weakness. But here's what you shouldn't do. You shouldn't wait for the perfect entry point. You shouldn't wait for gold to pull back to some arbitrary level before you buy. Because the reality is, in a bull market, the pullbacks are shallow and short-lived, and by the time you're comfortable buying, the price is usually much higher than where it is today. The other thing you shouldn't do is try to trade this. Gold is not a trading vehicle. It's a wealth preservation vehicle. It's insurance against monetary chaos. And you don't trade your insurance. You buy it, and you hold it. Now, I want to address something that I hear all the time from people who are skeptical about gold. They say, gold doesn't pay interest. Gold doesn't pay dividends. Why would I own an asset that doesn't generate cash flow? And here's my answer. Gold doesn't need to pay interest because it's not a yield asset. It's a store of value. Its job is not to generate income. Its job is to preserve purchasing power over time. And when you look at gold's track record over the last 50 years, it's done that job remarkably well. Since 1971, when Nixon closed the gold window, gold has gone from $35 per ounce to over $2,600 per ounce today. That's a compound annual return of about 8.5%. And that's without any dividends or interest. Just pure price appreciation. Compare that to the dollar, which has lost over 85% of its purchasing power during the same period. So the question isn't why would you own gold? The question is why wouldn't you own gold, especially in an environment where every major currency is being debased and every major central bank is trapped in a cycle of money printing that they can't escape from. And that brings me to the final point I want to make. This market shift we're seeing in gold right now is not just about price. It's about recognition. It's about the market finally recognizing that gold's role in the global financial system is not some relic of the past. It's a necessity for the future. For decades, the mainstream financial establishment dismissed gold as a barbarous relic. They said it had no place in a modern portfolio. They said it was for conspiracy theorists and doomsday preppers. But now, those same institutions are buying gold hand over fist. The central banks are buying. The commercial banks are covering their shorts. The sovereign wealth funds are allocating. And the smart money is positioning. That's the real news. That's the real market shift. And that's what gold is reacting to. It's reacting to the fact that the narrative is changing. The old story about gold being irrelevant is being replaced by a new story about gold being essential. And once that narrative shift is complete, once it becomes consensus that gold is a must-have asset in any serious portfolio, that's when you'll see the real move. We're not there yet. We're still in the early stages. But the signs are all around us. The central bank buying, the COMEX stress, the commercial bank positioning, the widening premiums on physical, the BRICS alternative, the Fed's impossible choices, the unsustainable debt, the geopolitical tensions. All of it is pointing in the same direction. And gold is telling us loud and clear that something big is coming. The question is not whether you should be paying attention. The question is whether you're going to act on what gold is telling you before everyone else figures it out. Because here's the thing about major market shifts. By the time they're obvious to everyone, it's too late to position yourself advantageously. The best returns go to the people who see the shift coming and position themselves early. And right now, gold is giving you that opportunity. So pay attention to what's happening. Don't get distracted by the short-term noise. Don't get shaken out by the volatility. And don't wait for permission from the mainstream financial media to take action. Because by the time they're telling you to buy gold, the easy money will already be made. This is your moment. This is your opportunity to get positioned before the crowd. And gold's reaction to the news, whatever specific catalyst triggered this latest move, is your signal that the time to act is now.